But this is really a rally now that's just like one stock. So the market's very narrow. The economy's clearly weakening. If you look at things such as financial conditions and credit spreads, and that's what I would really look towards to let me and my investors know when we need to get short, net short in the portfolio, they're still quiescent, remarkably. But this data is coming out just over the past month or so, is really starting to lend credence to the fact that we are slowing towards a recession. I think it's inevitable that we have a recession by the end of this year.
Financial markets are seeing an unprecedented convergence of high home prices, equity valuations, and narrow credit spreads. According to Michael Pento, founder of Pento Portfolio Strategies, these bubbles are all at record levels in relation to the economy. The equity market in particular has never been this inflated when measured against economic output. Credit spreads, which reflect the difference between interest rates on debt and safer government bonds, are also unusually tight, indicating potential market distortions. Recent economic data points to a significant slowdown. Initial jobless claims have reached their highest four-week average since September 2023, while continuing claims have also increased. Additionally, disappointing retail sales figures and a weak Philadelphia Fed report underscore the economy's fragility. Despite some sectors showing resilience, like the tech-driven gains in Nvidia, the broader market suggests an impending recession by year-end. The banking sector is under considerable stress as capital shifts from traditional bank deposits to brokerage accounts and Treasury bills. This movement has drained liquidity, with the Federal Reserve's reverse repo facility seeing significant outflows. As a result, banks are left with fewer reserves, potentially leading to problems in the repo and money markets. Pento warns that this liquidity crunch could escalate in the coming months, affecting various financial markets. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps.
Inverted yield curve inversion, so the 10s minus 2s, inversion in history. The longest inversion, which really brings down net interest margins for banks, because how do they make money? They have to pay their depositors, but they're collecting interest on loans. Well, if the interest they're collecting on loans is equal to or less than what they have to pay on deposits, it's a pretty hard way to make money. And if they don't want to raise their deposit rate, you have something called capital flight. People take their money out of the bank and they moved it to brokerage accounts. And you end up with a lot of money flooding into T-bills. So that's what's occurred. In fact, if you look at the reverse repo facility, something also I look assiduously at, is that has equated to the draining of that reverse repo facility, which is excess reserves from banks that was parked, laying fallow at the Fed. That has pushed, just in the last 12 months, $1.7 trillion of gambling money into Wall Street. So that money came out of the reverse repo facility, went in to buy bonds, newly issued bonds. That money is circling in the economy. And that's when you get, roaring kitty stocks going through the moon, and you have Nvidia going up, the market cap of Berkshire Hathaway in a few days. It's insane. But that's $1.7 trillion is now, there's only about $350 billion left in that reverse repo facility. And I'm really watching the bond market, because when that liquidity runs dry, and it's not too long away now, it's very close. Talking about months, not quarters. I think we're going to have a lot of problems in the repo market, in the money markets, in the stock market, and in the bond market. Those are the things I'm looking at, Donegan. It's not time to panic yet. I'm just saying, if you're going hog wild over your skis in Nvidia and going golfing and enjoying your life and saying, you know what, all you need to own is the number one stock in the AI phenomenon, you're in for a rude awakening. Because in my 33 years of doing this, being a licensed professional, this type of scenario has never ended well. And I look at something like the market cap of equities, total market cap of equities to GDP. It's 190 something percent right now. That's the highest reading ever, outside of like a couple of weeks immediately after COVID. So for reference, that ratio was 104% in 2007. It's almost 2 times more expensive. And in 2007, the market crashed by 50%, the S&P 500. Even though the bubble wasn't extent in equities, it was in real estate. And if you look at things like, well, how narrow the rally really is in the stock market. Because if you ask most people, they say we're in a recession and we're in a bear market. Because most stocks are down on the year. But if you look at NVIDIA is now worth over 10% of our entire US GDP. And if you add in Microsoft, NVIDIA, and Apple together, over 33% of US GDP, the total annual production and output of the United States, is less than those 3 companies. That's insane. The total market cap of equities to GDP should only be about 50-60%. But now we have 3 companies representing over a third. So this is a very narrow rally. We're heading into a recession. Banking system is under a lot of stress. Net interest margins, commercial real estate, auto loan defaults are spiking. Credit card loan defaults are spiking, even higher than they were prior to COVID. Rate of change is really moving higher.
In today's market recap, big silver rally of 2024 stalled. Why and for how long? The big silver rally stalled because speculators were unanimously long. The market does not reward consensus trades. The silver market will require less speculators before moving higher. Silver experienced a solid bull run in the period March to May 2024. Right before hitting silver's first bullish target of 34.70, the big silver rally 2024 stalled. Why? And for how long? Just to be clear, silver will hit $50 sooner or later. The question is when exactly. It's a matter of when, not if. Silver experienced an excessive number of speculators betting on the long side in the silver futures market. This, as said in our premium silver alerts since April, would prevent silver from moving much higher in the short to medium term. Speculators finally are giving up. Finally, they have been hit undoubtedly during those days with larger red candles. Remember, this is a futures market indicator. The leverage is insane when holding futures, so a 5% one-day decline has tremendous effects on a portfolio holding silver long futures. It's too early to get excited, but speculators leaving the arena is the prerequisite for silver to move higher. Lovely development, likely just the beginning. There will be a point in a few months where speculators will be hating silver, which is when we'll love it. Now we'll show you the best clips, but first, smash the subscribe button and turn on notifications. Enjoy the episode.
Planes up by 15,000. That moving average is also, forward moving average is also the highest in quite a while. If you look at Philly Fed that came out today, if you look at retail sales, great disappointments. If you look at pending home sales, they're all not anywhere near as projected. They're all falling well short of the mark. So I don't think we're in a recession yet, but we are tending towards that direction. And on the other side of the coin, you look at, the markets. If you look at NVIDIA, it's adding the market cap of McDonald's every day. When you have a very narrow rally like this, it tends to mask what's going on underneath. For example, would it surprise you if I told you the equal weight the equal weight S&P 500 is up 4%? That includes NVIDIA. It just doesn't overweight it because of its market cap. It equals it. If you look at the Russell 2000, that's down year to date. There's 2,000 stocks there. So lots of cross currents, but the economy is clearly weakening. It's being masked by what's going on with the AI phenomenon in NVIDIA. All such narrow rallies have failed miserably in the past. You look at the Nifty 50, or if you look at the .com phenomenon. Well, why is Jerome Powell and the maniac people who run DC, Elizabeth Warren, people who run Wall Street, like, Barry Sternlicht, who run real estate investment trusts. Why are they crying? Oh, we need more rate cuts. Oh, please, you don't get it, Mr. Powell. Please cut the interest rates. I mean, inflation has risen to a point where if you look at some of these sentiment surveys, University of Michigan, I'll point out, the U.S. consumer is on its back. They've been wiped out. The lower three quintiles have been wiped out because of the inflation that's already happened. So maybe this might be news to our president, Joe Biden. But inflation isn't coming down the way he thinks about it. Prices aren't falling. The rate of change is falling. So inflation went from 9% to 3.3%. That's still higher than 2, right, Dunnigan? But when inflation is rising at 3.3%, from a level that's already wiped out the purchasing power of the middle class, how does that help them? And Powell wants to declare victory now and start cutting rates, not because he cares about Main Street, not because he knows when he cuts interest rates, home prices will go even higher and be even more unaffordable, and oil prices and commodity prices will boom, and we'll have more inflation. I mean, that's the risk he's taking when he's cutting interest rates, especially if he does it aggressively. But he's doing it to protect banks, because that's all he really cares about. And Janet Yellen, Treasury Secretary Yellen, says, according to her, she thinks that the deficit and debt are in a good place. They're in a good place. $35 trillion in debt, 125% debt to GDP, $1 trillion in interest payments, $1.7 trillion deficits. The debt to GDP was about 60% a few decades ago. Now it's 125%, 123, 125%, around that level. And that's a good place. Dunnigan, if the debt and deficits are in a good place now, when we have prosperity and their ratio, I'm not just talking about the outstanding debt, I'm talking about the ratio is growing. So, the debt is growing faster than GDP. That's unsustainable, and she thinks we're in a good place. In good times, well, Janet, we're not in a good place. We're insolvent in good times. But when a recession comes, and I think it's coming, the data is telling me it's coming, and then unemployment rates spike, and then the automatic economic stabilizers kick in, and we have a $6 trillion deficit. I mean, who's going to buy it? Are we going to be Are we going to be in a really good place? Really, really good place then? So our leaders have gone insane, and all people care about is how good Nvidia did today. But I mean, I don't do that. I try. My charter is to make money in good markets, bull markets, bubbles, and also to get the heck out of harm's way when I see a bear market coming that's derived from a liquidity crisis or a recession, and we are headed there. I'm not positioned for it yet, but I'm prepared to get there quickly.
What do you think of Pento's take? Is he spot on and will be a massive recession by the end of the year? Or will he blunder his prediction and will the economy soar post-elections? Post in the comment section your honest opinion and share with us if you're concerned about a potential banking collapse. Thanks for watching. Subscribe if you have not yet done so, and send a super thanks if you find our recaps valuable. Now watch this video right here because you'll love it. I see you on the other side.